Welcome back to China's stock market. This is your weekly review. I am your host, Jack Kuzi. And as always, intermittently at the moment, but we're trying to keep it more consistent, we go through the weekly news that's going on in China's stock market, the second largest economy in the world, whether it be on its mainland exchanges or in Hong Kong, covering what is happening. And there's always things and news stories coming out of the mainland, of course. We cover them in this wrap-up. Welcome if you're an investor in Chinese stocks, if you're looking to invest in Chinese stocks, if you're thinking about it, or you just have a keen interest in what is going on in China, then this is the channel for you. If you are here, please hit the like button, hit the subscribe button. Let's keep those numbers growing. They are growing very slowly, but growing nonetheless. And without further ado, let's get stuck into it. Let's just run through a quick disclaimer. Just remember that the information that we give you here is for educational purposes only. It does not constitute a buy or a sell recommendation on anything that we talk about. And just remember, while I try to keep everything as factual as possible, in the end, this is my own personal opinion. So make sure you do your own research. Remember, stocks can be risky, particularly when you're investing in the mainland. It can be quite volatile because of overarching or different styles of economic planning and development. And we've certainly covered that in past weeks, and we'll cover it this week again. All right, as always, let's get into our agenda. We're going to go through the market performance. We're going to look at the major exchanges across the mainland and Hong Kong. We're going to do quick hits, quite a number of quick hits. I actually quite like doing this and concentrating on this. Rate cuts, I didn't cover this because we took a 2-week break, but we did see an unexpected rate cut out of the PBOC in the last couple of weeks. I thought that was pretty important. We're also going to talk a lot about fiscal stimulus this week. So we saw checks in the mail from the Chinese, national authorities, kind of putting money in people's bank accounts around China to buy certain goods in an attempt to boost consumer demand. We're going to have a look at earnings and how it's kind of a little bit disappointing at the moment from a general overarching bureau. We're going to do the Politburo, which issued a statement, the Ministry of Finance, which issued a statement, which I think will be very beneficial for stocks in the long term. And we're also going to talk about the lagging fund, the increased fund outflow out of China into areas such as Japan and India in particular, and how this could actually be a good thing for Chinese markets in the long term, of course. All right, so let's get stuck into it. Let's have a look at the market performance for the week. Now, remember, we run from Friday last week to Thursday this week. So roughly around the 24th of July into the 1st of August. A bumpy week, however, it eked out again. So the SSC composite was up 1.4%, the Shenzhen composite 2.7%, and the Hang Seng composite was up 0.26%. I think the reason for the SSC and the Shenzhen was some government stimulus. We saw some fiscal stimulus out of the Chinese this week. And basically, like I alluded to before, putting money in people's pockets so they could boost consumer demand. If we look at the monthly performance, 2.02 down, 2.39 and 2.06. We have seen a bumpy week from the US cousins and their counterparts, and a considerable sell-off in US markets in the last month. And China has kind of performed a little bit better than that and the lead that they've been getting from North American markets. Nonetheless, it has been a bumpy road, and you can see that by the 3-month performance. Down 5.72 for the SSC. Shenzhen down 10.09. We're in correction territory, or are in correction territory there, and 6.68% for the Hang Seng after a really dismal start to the year and then a really good run. We've since lost those gains. In fact, up until a couple of weeks ago, there was kind of a consecutive day losses on the SSC composite, which was kind of a record set since the GFC for Chinese markets. All right, so what's moving markets and what are some of the news stories coming out? Let's have a look. As always, there is always an EV story or a new energy story coming out of China. You talk about them increasing consumption, trying to boost consumer demand, particularly within the mainland. A few months ago, we saw an increase in the subsidy to 10,000 RMB for EV and new energy vehicle purchases. This has been increased to 20,000 RMB. And it depending on what you buy. So for an EV, it's gone from 10,000 to 20,000. For a gas internal combustion engine car, they'll be increased from 7,000 to 15,000. We did see electric vehicles and autos rose on the back of this. BYD was up 0.68, Li 1.91, GWM, I just bought a Great Wall Motor car actually, 1.63, Geely up 0.64, Xpeng 1.74, and NIO gained 0.15. Of course, the world's largest battery maker, CATL, also gained off the back of that, 0.86, and EV Giant gained 1.82. We saw a kind of little bit of thawing in India-China relations. Remember, they do have a border next to each other. The Associated Press noted that India and China agreed to work urgently to withdraw the withdrawal of troops on their disputed border. And we also saw the Indians relax or actually remove the restrictions on Chinese solar, wind, and electric vehicles, opening up that export market to what is a growing, rising Chinese industry and a world leader, in fact, that. I think this is a good point, considering China is being closed off from the rest of the world. When you look at it, I mean, the North American territories are pretty much closed off, particularly for Chinese solar, wind, and electric vehicles. We did see the EV tax or the tariff out of Europe raised in the last month or so. I think it's gone to 15 or 10% on the back of the Europeans accusing China of subsidizing these industries. So, we did see I will comment on the plenum. There was some carbon credit reforms around the plenum, and I think that was very well designed to ensure that they have access to European markets. The Europeans are big on, what type of carbon emissions you are producing when you're producing something. If you're under a certain level, then markets tend to open up for you in the EU. And I think a lot of the plenum, which got missed a lot, was around opening those markets for Europe. I think China sees Europe as a very, very important market for them going forward, particularly for their long-term economic strategic objectives. And then obviously India, with the world's largest population, a rising middle class, a consuming middle class, in order for China to continue upon its path on its desire to become the world's leading economy, then those markets in particular have to be open, considering North American markets seem closed, particularly in the US. I'm going to talk about Alibaba. So Alibaba introduced a 0.6% service fee for merchants on their Taobao and Tmall e-commerce platforms. Alibaba actually gained 4.2% off the back of that. This was announced on Wednesday, which would have been the 31st of July. It was the most heavily traded stock after that. And again, it announced a 0.6 service fee for merchants on Taobao and Tmall. We believe that the move, and I believe, and most analysts believe the move will have a positive impact on quarter three revenue, net income, and earnings per share, because obviously merchants are still going to trade on Taobao and Tmall, and previously that service fee, I think, was at 0, is now at 0.6, so should bring in more revenue. Alibaba making a lot of moves. I really like this stock. We'll talk about some of their AI moves that they've done in the next 2 or 3 minutes. Their reforming of their e-commerce platforms, their expansion into overseas through brands like Lazada. No longer in the eye of, I guess, the regulators within China. Stock price has not moved off the back of it. It certainly hasn't moved like its counterparts like Meituan or Tencent or Pinduoduo. I think it's just the forgotten giant of China, and I certainly have been adding to positions over the last 6 months. Tencent took center stage in the China Joy 2024 gaming exhibit. They showcased a wider range of gaming titles at the 21st edition of China Joy, which is a premier gaming and digital entertainment event organized by the National Press and Publication Administration of China and the Shanghai Municipal Government. We did see in previous, China stock market weekly reviews. We have seen a flurry of new games being issued, and China's gaming sector really starting to show some green shoots of being alive again in terms of innovation and new gaming after a lot of halts through, I guess, 2022, 2023. This year, Tencent Games exhibition booths occupied almost half of the huge hall N4 at the Shanghai New International Expo Center, where the Chinese gaming giant created dynamic and engaging offline interactive experiences for players themed around its various hit titles. NIO on July 26 reveals progress on autonomous driving chips in cars operating system and AI assistant. I also believe that NIO talked about producing a smartphone. So NIO gave updates on its most important technological developments, including the world's first 5nm chip for automated driving and its in-house developed operating system for vehicles and voice assistant powered by its large language model. Of course, NIO is acquiring a lot of data through their cars. NIO's fullest disclosure yet of its technological roadmap reflects how the Chinese electric vehicle maker spends its research and development money and how it has made a strategic bet on artificial intelligence, hoping to redesign all aspects of its vehicles, including self-driving and so-called digital cock. Now, this is an important notion because you got to think the car is an extension of your home and your office, and you're going to be in there a lot more when it's automated or it's auto self-driving. You can sit in your car for a lot longer while you're driving along places doing other things, and therefore the car is going to be acquiring data. I continue to talk about China's EV market to be more than just selling EVs to you. It's an expansion of, I guess, the tech industry and the data acquisition and then what you do with that data. A nice move there by NIO, a 5nm chip. I don't know actually who's going to be producing it, but they have designed that chip. Whether they can get a Chinese semiconductor foundry, kind of like SMIC, to produce that would be a massive move for Chinese tech going forward. Meituan's Kita, which is their expansion of their Meituan delivery services into overseas markets. Now, I will preface this by saying this is in Hong Kong, and you might be saying, how is this an expansion? But it is an expansion, and they're trying to attempt to lure more convenience stores like 7-Eleven to join its delivery platform in Hong Kong, according to Chinese media outlet Ximan, as the firm looks to add more merchants and categories as part of its expansion efforts. Competitors such as Foodpanda and Deliveroo, this is courtesy of TechNode, both deliver non-food items, which are still not available on Kita. The report said that adding that 7-Eleven will join Kita on July 19 currently supports users to order a range of hot food, snacks, beverages. I really like Meituan. I really like food delivery as a service. I think it's going to be much, much more profitable. And I think Meituan is now starting to up or ramp its expansion to overseas markets. They also have reportedly relocated some of its Hong Kong frontline staff to assist its Middle East operations amid an upcoming launch in Riyadh in Saudi Arabia. So we talk about where Chinese companies are going to grow. They're obviously going to grow in the mainland, but they're also going to grow through international expansion. And this is a perfect example of how this is going to occur. It might not be in North America. Meituan might not be delivering on the streets of New York, but they certainly will be delivering around the world. If you're listening to us on podcast, please leave a 5-star review and send this to your friends. All right, Chinese electric vehicle maker XPeng Motors said on Tuesday its advanced driver assistance system will be able to work on all Chinese roadways in the fourth quarter of this year. This will include roads within university campuses and corporate compounds, and will also cover parking spaces across the country, the company said. Again, this is courtesy of TechNode. The move will provide users with door-to-door automated driving experiences in every city in mainland China, though there will be exceptions for restricted areas such as government compounds and high security zones. Another move by XPeng. Posted in newsfeed was that Temu hits 20 billion in sales in half one, fueled by expansion efforts. So Temu surpassed its 2020 total sales in the first half of this year, 2023 total sales in the first half of this year to reach around $20 billion, $20 billion US dollars, according to a 36KR report, underscoring Pinduoduo's sister's app surging momentum as it pursues global expansions. We've talked about Temu before. It's one of the most downloaded apps across the world and in North America. Fast fashion retailer Shein, which is also largely rooted in China-based manufacturing, reported generating over $20 billion for the first time in 2022. So Temu surpassed that in one half. Temu and Shein's done it in 2022. Of course, we've talked about Shein before and their upcoming IPO, or lack of upcoming IPO, as they've been blocked from around the world. The report also mentioned, and we talk about overseas expansion, Brazil was second in terms of downloads for Temu app in the last 30 days, with more than 5 million downloads just after the US. However, the eye-catching sales figure still lags behind Temu's goal to triple its sales to 60 billion globally in 2024. I will note that in the last couple of reports by Pinduoduo, they kind of haven't stripped out Temu, and I think they're worried about being banned in the US. We talked about these import levies in the US, which were lowered during COVID, which allowed Chinese retailers, particularly Chinese e-commerce giants, to flood the market with good, cheap products. We call them cheap products, but it's all good, cheap products. And a bunch of US senators and US politicians really moving against this on the back of, data sharing and, human rights violations. Again, it's a tough market to navigate for Chinese e-commerce providers, particularly in the US, because they could be hit with a ban at any time. Baidu recently launched an AI digital human app, social app called Wei Zhao Yan. I know I've botched that, which is based on their Ernie bot. Basically, it's kind of like a nice face. There's a number of faces that you have. You can interact with it. You can ask it questions. The testing done by TechNote, I read an article that they did, said it's not bad, but you kind of get sick of it after 5 to 10 minutes because of the lack of bespoke or specificity and the lack of ability to design your own kind of AI bot. However, just a incremental move in China's AI space, particularly when you're looking at, text to image, text to video. And I think I continue to comment, if you want to back an AI play within China, Baidu, often the forgotten stock of Chinese tech, I think it's not a bad move looking at them. Posted in newsfeed, Uber and China, BYD's partner for 100,000 EV vehicles. So basically, ride-hailing platform Uber Technologies and Chinese electric vehicle maker BYD announced on Wednesday an agreement for adding 100,000 EVs globally, an alliance that expected to bring down the total cost of EV ownership for Uber drivers and accelerate EV uptake worldwide. So basically, you want to jump on the Uber platform. I kind of think this is going to work. You want to buy a car, you can buy it off Uber now. It's a BYD. It's low cost. It's electric. It's low to run. And then you can sit around and start driving an Uber, and eventually it'll be automated. So to offer Uber drivers in Europe and Latin America before later expanding to markets across the Middle East, Canada, Australia, and New Zealand. The two companies added that they will jointly work on autonomous driving technology. Obviously, Uber's got a lot of data to enable BYD vehicles on the Uber platform without revealing further details. Tesla chief executive Elon Musk commented on X that BYD needs to change course fast, otherwise the company would be in trouble, seemingly alluding to the Chinese firm's relatively late start on self-driving technology. Hey, who's to argue against Elon? Temu's Chinese suppliers protest in Guangzhou over penalty policy. We talk about good news for Temu. Here's some bad news. Hundreds of Chinese suppliers gathered outside Temu's Guangzhou office building for a few days at the end of July to protest hey, who said you can't protest in China? As merchants were growing angry over the e-commerce platform's after-service sales penalty policy. Videos circulating on social media platforms showed part of the protesters even getting into Temu's office on the 25th floor, despite strict entry restrictions, with common demand to get back their retention money, which was being deducted on a pro-rata basis by the Pinduoduo sister app in response to post-sale issues. According to Chinese media outlets that has talked to protest suppliers, Temu has been issuing a large number of fines since March without giving them notice. If you don't know Temu, obviously we've alluded to this before, it is owned by the Chinese e-commerce giant Pinduoduo and is one of the largest growing apps across the globe, including the United States of America. That's all for us for quick hits today. Again, if you're not subscribed, please subscribe to the channel and give us a like and give us a comment. Let's move on. So the Chinese did cut rates around 10 days ago. It doesn't cover in the weekly wrap. However, I did want to cover it because we did miss a few weeks. It was quite unexpected. I think it was off the back of the third plenum, and particularly off the back of the GDP numbers that came in quite lower than the annual rate of 5%, came in at 4.7. I think they wanted to show a commitment to achieving that economic growth target. They wanted to address the weak data and the sharper than expected slowdown in second quarter GDP. They also wanted to stabilize bond markets and support the yuan. I think they were hesitant to do this earlier because they were concerned about what the US was going to do with interest rates, and they're also concerned about the yuan and the stability of the yuan, and the fact that the yuan was on trading at 2 or 3 lows. They were also concerned to think about bank profitability. When you look at some of the Chinese major banks, and the reason why is, when rates are higher, banks tend to do better because they lend money out for a higher rate and they take it in, right? People deposit money in the bank because rates are higher and then they lend it out, and that's how essentially traditional banks make money. You lower rates, you might affect their profitability. On the back of some of these big four China banks or these big Chinese banks who, look at the stock prices on some of these things. They have gone on an absolute run and tear, I think mainly because of their dividend yield, which was trading at around 7%. We covered that actually a few months ago. They're looking at smaller rate cuts here to boost economic activity. So what they did was they reduced collateral requirements, particularly on banks maintaining liquidity in the system. However, the market really didn't move towards it. And I think this was, a move in line with some more moves that we saw as the weeks came on the back of the third plenum. I'll just comment on US rates. I think we all realize now that the US is probably going to lower rates. So central banks around the world feel a little bit more comfortable in lowering their rates in anticipation of that. Which will also help against their currency if the US lower rates, because that interest rate differential is then less and you don't have a movement out. China's worried about fund outflows because they've had a lot of fund outflows so far. We continue to see moves by Chinese authorities to try to stabilize the economy. I was asked on a radio segment a couple of weeks ago, is this going to help the property market? And I said, no, probably not. And look, I think the property market in China is near a bottom. But the question is it going to have like this vertical recovery? And the answer is no. And people ask why. And I said, I don't think the Chinese want it. They're not very concerned. The most people that are most concerned with the Chinese economy tend to be people outside of China. The Chinese government and the Chinese regulators aren't as concerned as everybody else is or the Western media is. Now, that might be right or wrong. I don't know. I have a thought on it, and I'm not as concerned as other people are as well. And then we talk about a consumption-based economy. I think a couple of years ago, we made this mistake, and I was one of them. Analysts around the world made this mistake and said, China's got to move to a consumption-based economy in order to get over the middle income trap, and this is their move, and this is what they're going to do. rather than move from being an export-driven economy to a consumption. No, they don't want that. And I've come to the conclusion that they do not want that. They are full steam ahead on remaining an export-driven economy. I believe China wants to be the Amazon of manufacturing around the world, where you go on, I don't know, like a Chinese centralized built system, and you pick what you want manufactured in their factories built by robots and artificial intelligence, and you get it done. And if consumption on the back of being an export-driven manufacturing economy comes, then yep, great, tick. We become a consumption-based economy. But if it doesn't, I don't think they care. I actually don't think they care. Now, this goes against most conventional modern economic policy of becoming a consumer-driven economy in order to maintain that growth and, build your people's wealth, etc. However, China doesn't do things like everybody else does. We did see some fiscal policy during the week. We're going to cover that now. Actually, let's just cover it right now. Checks in the mail. So the National Development and Reform Commission's NDRC announced that half of the RMB 300 billion worth of long-dated government bonds, I think these are 50-year bonds, will be issued to support a 15% subsidy for MLF goods. Now, what are MLF goods? Now, here's what they mean. So, individual consumers to purchase 8 types of home appliances, including refrigerators, washing machines, TVs, air conditioners, computers, water heaters, household stoves, and range hoods. Here's a check. Here's some cash. Go and buy them on these 8 things. Kind of like the checks in the mail during COVID with the US government and most governments around the world. Off the back of that, appliances companies like Media Group, 6.53%. Heya Smart Homes gained 8.3%. And Green Electric Appliances gained 5.79%. These 3 companies were also net purchased by the Northbourne Stock Connect, so that's money coming in from Hong Kong. The biggest e-player commerce, and you've got to think that you're going to go on e-commerce platform to buy these, or in most cases, JD.com. So the biggest ones in home appliances are JD.com, and that moved 3.02% in Hong Kong versus the ADR move of 2.21%. I'll skip this one here for a moment. I'll just go back to a Politburo statement. So then there was a Politburo statement kind of the day after this one that came out, and a Ministry of Finance statement that was also done. So a bunch of just government statements that came out around, which led to a really strong rally in growth stocks and sectors on very high volumes in China, and that came on the 30th of July. Well, the rally came on the 1st of August. So this Ministry of Finance press conference statement was led by Wang Dongwei, the Vice Minister of Finance. The press conference was intended to introduce the relevant situation of fiscal support for promoting high-quality development following yesterday's Politburo announcement. And basically, what had occurred here was there was an emphasis on domestic consumption to boost economic consumption, I should say, amid concerns around economic growth. There was leadership to support accelerating fiscal and monetary policies to address insufficient domestic demand, and I think fiscal is the key component here. Measures included government bonds to fund spending and upgrading industrial equipment and consumer goods. We've also seen tax drops in EV sales or EV purchases. There was an emphasis on economic policy shifting towards benefiting the people and promoting consumption. I know I just said they won't want to be a consumption economy, but they are trying to boost it, certainly. This is off the back of recent policy interest rate cuts aimed at improving growth, hampered by a real estate slowdown. So we just saw kind of, some shots across the bow in order to do that. And some of the quotes that we saw coming out of the Politburo was the focus on economic policies should shift more towards benefiting the people and promoting consumption. It is necessary to increase people's income through multiple channels, and economic policies should enhance the consumption capacity and willingness of the middle and low income groups. And when we talk about those market gains we saw during the week, a lot of them came on the back of these days, which were big days or big green candles in Chinese markets, because of the perceived notion that China was also starting to step in through fiscal policy and really step in through the consumer by basically putting money in their pocket and saying, go out and spend. The Politburo also reiterated high-tech plans and emphasis on boosting middle and low-income group consumptions. There were no new consumption measures focused on implementing announced around measures like bond issuance and equipment upgrades. And I think this is off the back of warning of disinflationary pressure due to weak demand and high supply, booming exports, but rising imports lagging, causing trade tensions, particularly between the US and Europe. We also saw some potential trade tensions to escalate during that time, with a tariff increase warning from presidential nominee Donald Trump within the US. All right, let's talk about this report produced by Morgan Stanley and published by Bloomberg. And you can see it in front of you if you're listening on YouTube or watching on YouTube. And if you're listening on YouTube or podcasts, the title is China's Earnings Recovery Stumble to Test Conviction Call. And there's a chart there of the net positive as a percentage of all A-share listed companies. And I'm talking about net positive earnings seasons for these companies, and how it's kind of, moving below that zero mark, indicating maybe a negative net earnings across where we're coming into into earnings season. So main listed firms' profit warnings for quarter two outnumber positive alerts, and that's what the chart is alluding to, resulting in a net negative tally of 4.6 compared to the prior quarter's net positive of 2.2%. The impact is that a disappointing earnings season may test the bullish outlook of UBS Group and Societe Generale's, driven by expectations of improved Chinese corporate profits. A surprise miss in quarter two economic growth and lack of consumption boosted policies are leading to another stock sell-off, which we've been seeing. There has been no substantial improvement in companies' cash flows, with a dominant wait-and-see market attitude due to unclear mid to long-term economic policies. Consensus estimates from firms like CLSA may have been overly optimistic about earnings recovery. Morgan Stanley analysis of 1,650 preliminary results suggested delayed earnings growth reacceleration, and it's too early to call a bottoming out of earnings season. We did see airline losses in the last couple of weeks. So China's three biggest airlines warned of a net loss of half one 2024, indicating weaker consumer demand, particularly in travel. We did see a big boost in travel off the back of the Lunar Year, but that seems to be abating. There are consumer companies risk. Analysts at HSBC highlight a moderate risk of Chinese consumer companies missing estimates due to economic headwinds. After the mid-July rebound during the third plenum, Chinese stocks resumed their decline, with the CSI 300 index losing nearly 9% since May. Foreign investors, and we're going to cover this in a moment, are on track to withdraw money from local equities for the second consecutive month in July. Recent support measures by the Politburo had little effect on stocks, as policy-driven rebounds have been modest. There has been an industry divergence. Export-oriented companies are performing better due to global demand, while domestically focused companies are underperforming. There is another chart there, if you're listening in, showing that larger firms are showing more resilience, and that is to be expected in an economic downturn or lagging economic growth. They've got bigger balance sheets, they've got wider range of services and products. So larger companies show more resilience with a net positive rating of 1.3%, while small and medium cap or mid caps show negative ratings of 11.7% and 8% respectively. And this is courtesy of Morgan Stanley, and the article is from Bloomberg. So earnings not as good as anticipated, certainly as we're becoming. Big companies doing better than smaller companies, and the consumer isn't just coming back, and exports are doing well while consumers aren't doing as well as possible. Maybe checks in the mail might help this. However, there are some positive signs for Chinese stocks. We talk about Chinese stock buybacks. There's an enormous amount of cash. You have regulation kind of being removed. There is Chinese expansion overseas, which I think will be a driving story as we go along in the years to come. But sentiment, not great on Chinese equities, which has been the case for quite a long time. I actually had a meeting this week with an ETF provider that we use to invest some of our clients' funds. We use ETFs here. I think it's a great way of investing. And I said nothing about my keen interest in China. And I asked the analyst, there's a major ETF provider around the world. And this analyst had spent 10 years in Hong Kong, studied Chinese companies. And nowhere during the presentation on some of the ETFs they thought would do really well, did they ever talk about China. And then I asked, hey, what are your thoughts on China? I'd be pretty interested. And he said, we don't like Chinese outlook. Consumer demand is not as good as we think. We haven't seen boost in stimulus. All the same stories. Foreign fund outflow come out, etc. And I felt like saying, China doesn't want to boost consumer spending. But I didn't. He talked about the property market not reporting, not recovering. And that's the notion. That is the notion across most analysts around the world. There's no growth in China. You still get those areas of China as uninvestable. And I often say, or I think, and again, this is not a recommendation, when everybody is fearful, it is time to get greedy. And when everybody's greedy, it's time to get scared. But I don't say that off the back of nothing. I say that off the back of this is the world's most important economy. This is a country where BYD has just done a deal with Uber. This is the country which has the largest battery maker in the world. This is the country which has the second and third largest e-commerce platforms in the world. This is the country which is the largest car exporter in the world. This is a country that is leading in terms of solar and renewable energies around the world. This is a country with the 4 of the 10 largest banks by Tier 1 capital around the world. This is a country that is the largest exporter in the world. This is the country which is the second most advanced manufacturer in the world. This is a country with names like Alibaba, Tencent, Meituan, Pinduoduo. We're not, and this is what bewilders me sometimes when people say China is uninvestable. Yes, you have to deal with a lot of different things within China, no doubt about it. It's just a different way of investing. But I continue to believe, and I kind of left with egg on my face, that China will be the most dominant economic superpower in human history, and therefore its companies will benefit from it. I could be proven wrong. I certainly have been in the last 3 years. But their companies may have been lagging in their share price. But China's economy continues to make leaps and bounds, contrary to what you read or hear in newspapers. Okay, that ends this week's weekly wrap. I thank you very much for joining me. Once again, any way you can support us by just leaving a like or a comment or a 5-star review if you're listening to us on podcasts. Good luck. It's going to be another bumpy week, particularly with leads coming out of the US. But I'll be back here next week. My commitment is to really consistently get this out week to week. I am going away next week, but I'm going to come in on Friday morning and film it. And my anticipation is to get like 10 or 12 in a row here. So I appreciate those of you who have been tuning in. There are a few of you, and I appreciate it. And have a great week and good luck with your investing.